Hi guys, it's great to have everyone here today. So for everybody in the line, we have three of the leading trading firms and market makers in the crypto space with us. So first, Dan, who is partner at CMS, then Bryn, who is CEO at MGNR, and Evgeny, who is CEO and founder at Wintermute. All of them are involved with the dYdX perpetuals market to various levels and all participated in last week's poker tournament as well, I believe. So the plan is to spend the first 20 to 25 minutes on quick introductions and a few roundtables with quick answers on various topics from each of them. And then the plan is to spend the rest of the time, so about 50 minutes or so, on three meaty debate topics before a rapid fire session and audience Q&A to close things out at the end. As a heads up, the audio here will be recorded and transcribed afterwards. So first things first, can you guys give us a quick introduction on the founding story of your firms and your backgrounds, and talk a little bit about the types of strategies and products that you focus on? Maybe we'll start with Dan and then Bryn and Evgeny.
Cool. Yeah. God, I've been trading crypto now pretty much the entirety of my sort of professional trading career. I jumped into this fairly early when it was sort of just a very, very small asset class with some potentials. This was around late 2012, early 2013. I worked at Kraken as my first stint. People don't know this. Kraken's been around since like 2011. I think Jesse just wrote his like 10-year sort of like recap. But from there, I went to work at Circle, where I worked for 5 years running their OTC sort of desk. OTC now is like much different than it was then. Like, not all, but a very, very sizable amount of like the order flow was going bilaterally back then. Exchanges were a lot more dicey. There was a lot more like concerns around compliance and regulatory sort of risk with facing like these offshore venues. For like, just as like a proxy, like we would typically do sort of about what you'd see Bitstamp do in a day, sort of on like the high touch. And like that scaled pretty well with 2017 when it got really big. And then like the desk obviously like grew into all other asset classes and things of that nature. So that was primarily like my trading background, and then spun off CMS on the back of that with a guy named Bobby Cho, who ran and worked at Cumberland DRW, their big crypto trading shop started by Mike Komaransky back in the day. And a guy named Julian Sagan, who actually was the back end sort of infrastructure guy with me through the whole time with Circle Trade. So we trade partner capital, but we run two sort of books. One is liquid active sort of trading strategies. This is like pretty heavy derivative based these days. We do a bunch in the options like flow as well. We don't take counterparties, so we're not like taking risk from other people and like trading that way, but we do a bunch of different like stat RV type stuff, and then like funding related trading a lot. And then we run a venture book, which is probably where people have seen us more, because that's like where the sort of like headline stuff comes through. And like that's mostly longer tail of like issuance for anything with 1 to 7 year sort of like liquidity horizons, and a blend of tokens and equity, but like really sort of like heavily skewed towards the token side, as we know that. So that's like our sort of where we fit into this space.
Okay, I'll go next. Thanks, Dan. So, hi, my name is Bryn. I'm the co-founder and CEO of MGNR. Our background is myself and my co-founder are both from the TradFi derivatives trading world. So we worked at a number of two different spin-offs that started from ex-Optiver guys. Worked in Hong Kong for about 4 years. An option market maker there, and worked on various sorts of quant strategies and index and single stock derivatives strategies, and then later moved to Chicago and worked at another Optiver spinoff, but in the more competitive and more liquid US market. So at that shop, I was involved in treasuries and fixed income option market making and a number of other quant strategies around that. Got into crypto in probably early to mid 2017, and it was actually my co-founder who got me into it. He was passing through town and came to stay on the couch at my apartment, and him and another friend at the time had been kind of getting into Bitcoin, and he educated me about that. And they actually just started building a model market maker bot on Bitcoin, and So just as a hobby project after work, we sat down and had a look at it, and it kind of just after looking at the market in 2017 for a few minutes, like you can see how much edge there is, and especially putting out at the time basis and various just like kind of standard futures bases on BitMEX at the time just had a ton of volume in it and were just all over the place. So it was pretty attractive, and that's the first time we started getting into that. Since then, we've just continued to grow for a few years and become one of the larger quant market makers in the space, where we have a super strong focus on automation in our core business. So everything is completely automated on the CFI side of the world, and that's not quite as easy on the DeFi side of the world. So we just because of the nature of the space, things are changing so quickly. So we kind of try to be a bit more dynamic there. I'd say we were a little later to the DeFi side of the world. We probably got into DeFi in earnest maybe Jan or Feb 2021. So we missed the super juicy 2020 summer. But now we have various DeFi books and do some opportunistic trading strategies. We do industrial yield farming, and we have a venture book as well that we kind of got into since about February, March time. Evgeny.
Awesome. Yes. Hi, everyone. Yeah, it's Evgeny from Wintermute. I'm a founder and CEO. So my background is pretty similar to Bryn. So basically, prior to creating Wintermute, I was working at Optiver, which is the largest market maker, primarily in option space. And I was there for about 10 years on Delta One spot. Traded pretty much everything Delta One, but with a special emphasis on ETFs, and basically ETFs on pretty much everything. So basically like stocks, commodities, bonds. Basically, I tried pretty much everything, and I basically built the market making desk, and basically like in 10 years time, I kind of felt that Opti was becoming like too big and too I don't know, not to say bureaucratic, but just like not interesting enough in terms of growth. And I went straight into crypto with other two ex-Optiver guys, Johan and Hara. And we basically started with back early 2017, mid 2017, when it was just like getting, pretty hot in terms of like growth and Bitcoin going up and everything. So we started with basically just doing simple ARBs within exchanges like Coinbase, Kraken, and our first sort of first idea was basically to be a market maker for projects. And that's kind of what we started with, and from that we kind of evolved into being a more traditional market maker. So I think we basically in 2019 was when we started looking into DeFi. Started with dYdX actually. We were one of the first market makers there. And 2020 was when we grew our DeFi capability quite a bit. And in general, it was like a massive year of growth for us, where we grew basically from I think like less than 10 people to over 30 by end of 2020. And where we are now, we are trading all the major centralized exchanges, but more importantly, I think we are pretty much present on all the major Ethereum protocols trading-wise. We are doing both CMMs, we are doing central order books like dYdX, we are doing RFQ provision on Paraswap and 1inch. And in general, that's the core business. So we are doing market making, liquidity provision, and there is also a significant strategic part where we still provide liquidity for we basically do market making for projects, and we do have a venture book as of basically end of 2020, which we also aim to grow, and do a bit of farming as well, but it's not as big yet.
Awesome. So to kick things off on the roundtable side, wanted to get your views on where we are in the overall cycle. Obviously, we're in the second half of 2021 at this point, and wanted to get your view on your top 3 theses for the second half of the year and beyond.
Yeah, I can jump in. I can't hear Dan after. Can I go?
Yeah, go for it.
Sure. Well, actually, I'm I try to stay away from macro predictions or theses that I get too attached to. It's partly just trying not to tunnel vision ourselves too much. I think it's not the same for every trading firm, but if you come from a higher frequency, kind of shorter time horizon quant side of things, you often focus on very high probability trades, and so if you kind of become too intellectually invested in certain macro theses working out, it can sort of hamstring your agility or your just mental ability to kind of change paradigms. But I will give a couple of predictions or things that I think might happen in second half of 2021. One of them relates to the option market specifically. I've kind of been writing this thesis for a while and haven't heard a lot of people talking about it, but the way that I see crypto options market, or a reasonably high probability of the crypto options market evolving, is that eventually, finally, when we get a proper ETF approved in the US, I think that people will just start trading equity options on that Bitcoin ETF as a proxy for crypto market options. And so, that's not a certainty. I mean, there may be other crypto options markets that continue to evolve in the crypto space, but almost unintentionally or ironically, I think most of the Bitcoin options action will end up on listed US equity exchanges, and I think Citadel and Optiva will just become the main market makers there, thus making it like almost shutting out or making it hard for crypto native market makers to be involved. And yeah, no moral judgment there. It's just that's what I think is likely to happen. Another thesis that's kind of probably consensus at this point, but just continued institutionalization and regulation in the space. I think it's actually going to make DeFi a lot more boring than it has been. So I think unfortunately we've probably been through the most fun year or 2 years of the history of DeFi, and every year it will become increasingly vanilla and increasingly sort of derivative and copycat the sets of ideas and the concepts that are played with as things ossify in place and network effects kind of like establish themselves. So that's a little bit sad, but try to make the most of it while things are still in the fun stage right now.
Dan, over to you.
I'm back, by the way. I have now learned that if I leave the Twitter app, I get booted and I become a listener. So I'll stop doing that. So I'm actually curious, just to piggyback on the last comment, how much of like option order flow for gold is GLD related to sort of like either like the CME products? That would be like a great, interesting like data point. Just curious how that played out. So as far as like what I see going, I'm going to be a little more bullish. I sort of have been like obviously yelling on Twitter about this, and like obviously if you ever ask me personally, I would tell you too. I think you really need to look at like how much money is moving into the fundraising side. Like there's billions of dollars almost weekly at this point that you're seeing sort of raised either by projects or by funds that are going to then like raise with projects, right? Like there's a tremendous amount of like private money moving in, definitely on like the equity side. Like the corporates are just like sort of, I don't want to say like anything's too rich because like that always has come back to haunt me, but there's just a lot of money pushing through this system, and it's gonna find its way into like the liquid stuff at like some portion. Like this is just like historically like how we've sort of seen it. There's been cycles of this, right? Like the corporates get a ton of financing and it doesn't make sense relative to the asset class, and then the asset class balloons, and then like you get like the sort of like flip back and forth like as it goes. So I think that's going to continue. I don't see any reason for that to abate. I mean, like we have a lot of conversations in the background, really just sort of like I've said this before, like we take just like phone calls sort of for no reason, but we talk to a lot of these funds because we want to know like what they're doing, what they're raising. And I say funds like traditional sort of like money, like guys that like run like long short equity books, and they're like, yeah, we're looking at this like crypto thing, and it's like, well, this is new, this is interesting. And like we've always had phone calls like this over the years, but now we're seeing them like actually raise money or like punching into some of like these startups as like their first checks. Because like what tends to be is the easiest way for them to get exposure to this stuff is to just shoehorn it into something that like exists in their like existing world somewhat. So they're like backing venture bets with like on corporate equity, which makes a ton of sense because that's like very easy to fit in their risk profiles. So, but they're going to move out the risk curve, right? Like this is just like the stepping stone of them being like, oh, like now we like own some Bitcoin and Ether like spot. And like, oh, now we're like doing this token project, or like now we're like farming this. Like it's all just like baby steps in that direction. And I think you're just seeing a ton of money like pile into that. I tend to agree. Like I think DeFi will get more boring as time goes on. It'll just get like arbed out. Like the interest rate sort of like imbalances of like the real world and DeFi are gonna have to come in. So this is like another big thesis I have, is that like there's this huge disconnect, right? Like risk free, even though it's like a much different definition of risk free, of like cash lending in crypto is just like on a different planet in comparison to what you see in basically a negative yielding world outside, right? Like those are going to converge. Like there's going to be a ton more money moving in, barring any regulatory like shock that like stops that like flow of money coming in. Like stable coins are just going to continue to go up and to the right indefinitely, massively, as long as there's like yield opportunity or just like opportunity in general to like earn anything. So I think that's going to continue, but like the backside of that is going to like crush sort of like these like juicy, ridiculous like rates that like everybody's gotten accustomed to in this industry. The other thing that I have is I really do think there's, and not to chill obviously like what we're like talking about and our host here, but like I very much think that like the push to, in particular, perpetual products, but like really all sort of futures into DeFi is an inevitability. I think you just like, look, I think the big shock that's going to like push it is there's so much regulatory pressure coming from so many different directions on so many different venues for so many different things that like at some point people just like bounce to those for whatever reason, like most likely that they just like can't operate on like whatever venue they were looking at any given point, or even just they're like worried about like the potential of not being able to operate on that venue, and they move into these DeFi products. And there's a real win if you never have to leave and you don't have to worry about that problem in the future. And I just think that is the stickiness to get people to move over, and then they just like won't move back. So like I don't think that they're gonna beat out their centralized counterparts, but like the DeFi deriv space is gonna grow in order of magnitude. I'm a pretty big buyer of that thesis. And I think that you're just gonna see a continued onslaught worldwide on a lot of these centralized venues. That's gonna be like the real just quick reaction to get people to move there. But then once they're there, I think they're staying. Like I just like don't think they're leaving. So I don't know, those are the biggest things that I like have conviction about right now, sort of in the market.
Yes, great. Yeah, it's kind of funny because like for me, I'm somewhere in between, I guess. So I'm not so optimistic, but I'm also like not necessarily. I don't necessarily have this like pessimistic message that everything will go to CME. But I think what we will see is, well, first like the macro thesis I would have is we'll see kind of two worlds. We'll have this traditional finance world of like CME and Eurex with options and futures and everything else product trading there, and basically majority of institutional investors like big funds still trading there because that's how they used to do it. At the same time, you'll see like this massive, Cambrian explosion continuing in derivatives and pretty much everything on the DeFi side of things. And I guess once we see once we see enough of those institutional investors like taking a leap of faith or taking a leap of regulators, I don't know like which one it will be, maybe both, going into DeFi, like at some point I think the flood will just burst and CME will die, and I think that would be pretty nice development to see, because I think it's, well, for all us market makers and in crypto, that like we'd rather continue this space to develop, continue this technology to develop and grow and basically overtake the like CMEs of this world. But it's also possible that it will never like work out, and I don't know, CME will take on some of the, I don't know, best practices. I mean, maybe put some of the settlements on chain or something, and will just continue be CME dominance like we saw in the past. Because like if history teaches us something, then it's CME has a pretty strong positions, and the traditional exchanges have pretty strong position. Like jumping into like more in the micro world, like one stuff I'm quite excited about is just how the derivatives on DeFi are gonna manage the capital efficiency, especially when it comes to option side. And in particular with dYdX, I'm quite curious like whether, for instance, dYdX can copy their bit model and just list options on all the perpetuals it trades, and basically therefore establishing like this capital efficiency for market makers and kind of basically pretty much copy paste in Deribit. I think that would be pretty interesting approach, but also anyone can do it in a way. But like in a pure DeFi fashion, I think it would be really interesting if instead like protocols like Open, for instance, or some other ones, basically once they allow everyone to liquidate everyone, I think it can also be another way for us to see this capital efficiency as long as like there are enough market makers who can manage those liquidations and make markets efficient and make sure that the whole protocol is like properly collateralized. And the final one, I would say, like one thing I'm really bullish about, and is basically like index investing. I think that's something that didn't really get a lot of traction in DeFi and crypto in general yet. And partially it's because it's still quite tough to like build DeFi native indices on cross-chain assets. But partially it's just because, I don't know, I think majority of people on crypto Twitter are saying they can outperform the market still, and a lot of them do. But I think as we see a lot of new participants coming in, it will be harder and harder to do, and we'll just see like what. Basically, my big bet is that we'll actually see a big flow of funds into those like DeFi ETF products, where like once people realize it's just like much better way of investing longer term.
Yeah, it's a good spectrum of views there. So moving on to the second of three roundtables that we had, could you guys each talk us through a kind of a high level how you model your spread pricing? So given that market makers tend to the spread tends to be the engine of profit there, how do you guys think about that? And maybe if it's pretty similar, then if you guys could also speak to kind of how that compares to how you modeled it in sort of the TradFi world, and if there are any kind of stark differences in terms of how you do it in the crypto space. So maybe Dan, if you want to go first.
Yeah. I mean, I'm the least pure market maker sort of on this panel. So like my answer will be like obviously a little nuanced. Like our liquidity provisioning that we do in any capacity is like pretty much all DeFi related. And it's like obviously like being an AMM is like you can consider that liquidity providing, but like really just like as these DEXs are getting bigger on the derivative side, like we're trying to be more and more what we used to sort of traditionally do in the market making side of the business. Back when I worked at like Circle on the OTC side. I mean, like I could speak a little more to that world when we used to do this, where we were like pumping out liquidity sort of like everywhere. I mean, it was just fundamentally a function, at least at that time when I was doing it, of like how off the exchanges were to each other. Like that was like our proxy of like what we needed to like be making as like EBS capture, because there was just like such a long time in the industry where you like just got paid for pushing like plumbing around, right? Like buying here, selling there, like brain dead, just like getting the money through the system. And like we're like, all right, well, that's like the edge that we sort of like need to justify like doing this. It's like that's like how much we need to like make in order to like get this going forward. But like as far as like market microstructure of like how we like would set bid offer spreads now, like and stuff that we do like in the DeFi land, like I mean it's really just a little bit of like a finger in the air being like, look, this is what the vol is like how much like volume we're seeing like punch through. This is like where we think like it's an acceptable level of like what we should be getting. It tends to be more that not like, oh, we need to like optimize this to the last thing. It's like, all right, like we have this opportunity in this like subset of the market at any given time. And like we see this larger opportunity so much like further away. Like where does it make sense to like have the capital? And like borrow has gotten a lot better. So this is like less of a problem. But there were definitely days back in 2017 where it was like every dollar we had that wasn't spoken for like had to go to Bitfinex that morning because there was like a 7% wide spread to like Coinbase, and like trading any spread on any exchange like individually didn't make sense because like that money was better used just like cycling through the pipe. So you have like a lot of stuff like that, I think, pushing against market makers at times that will indicate like sort of like it's weird, right? Like that Coinbase Bitfinex spread basically sets params for like how we would quote any individual exchange, but like it's not necessarily intuitive of like why that width would be like related to that. But that was like because the capital problem on the back end. But like that's also not as big a deal these days because there's just so much more money and so much better access to borrow. So I don't know. I definitely tiptoed around your question a little bit there, but that's sort of like my background to it.
Yeah. Bryn?
Yeah, sure. I can speak to that a bit. I think it's interesting that your question is about spreads because, so, like if you broke market making down into two high-level components. One would be the valuation, which is at any point in time, what do we think this instrument is worth? And then the second part would be the spread. So how much edge do we need to do a trade on this instrument? And so you can quote a spread around your valuation. And so from a quant side, by far the majority of the effort and thought goes into determining valuation rather than spread. The spread itself is can be somewhat arbitrary, and you'll still have perfectly acceptable outcomes if you have a good idea of the valuation. But because we are talking about spreads, let's just I won't give away too much secret sauce, but just thinking about a few different high level inputs that are quite well known and would make sense in determining how to work out the spread. So fees are a starting point. So you have to at least make back the fee. So whatever money you wanted to make before, you linearly add the fee into your spread, and so that works in both DeFi and CeFi, right? Like if a protocol has better rebates, we like by 2 basis points, then we're 2 basis points tighter. And if a protocol changes their fee structure and taker fees are an extra 5 basis points, then we need an extra 5 basis points to do a taker trade. So from the protocol or exchange perspective, it's pretty easy for them to understand how to generate volume that way. Some other ideas, as Dan mentioned, volatility is a big factor that you might want to consider in your spreads. In general, if it's a more volatile market, you need a bit more edge because there's higher uncertainty in the outcome of any given trade. And I think another useful framework to think about is I wish I had a pen and paper. I like to kind of draw this in a 4 squares sort of grid, but different. On one axis, you sort of have amount of turnover in a product, so ranging from low turnover to high turnover, and then basically the higher the turnover in a product, the tighter you want to be with your spreads in general, because you'll make more money trying to capture two-way flow versus in other products with lower turnover, you won't be able to flip your inventory as frequently, and so you'll be carrying inventory. And in those products, it's better to try to take a bit more of a position taking approach and try to have positive carry on the positions that you're accruing. Let's see if Evgeny has anything to add to that.
Yeah, I think you covered it pretty well. It's actually pretty much what I wrote of myself preparing for this. It is on one hand you need basically when we look at the spread, besides taking the fee into account, you do need to know the volatility, and you need to know how much you can basically scalp in between your bids and offers at any given moment. But and that's all this plus your pricing is the secret sauce of any market maker. And if you nail that, then you will be successful. If you don't, then you won't be that much successful. I think I'd like to add a bit. There is a bit of speed, being taken into account as well. If we know that we are, I don't know, maybe not the fastest market maker on a given exchange, we would also quote wider. Or if there is if there is an element to it where the execution is kind of random, our order can get stuck, for instance, and we can get executed in a minute time, on some really awful exchanges. We might also quote wider just to account for that, because we give too much optionality to people who might be just arbing it manually, or maybe the exchange is running its own market maker. Everything is possible in crypto. But in general, I think that's it.
Great insights there. I guess moving on to the last roundtable discussion, what advice would you give to pro traders, quants, or ex-traders looking to get into crypto trading or market making? And how does having LP capital versus managing proprietary capital influence your overall thinking here?
Yeah, so I'll take this one because I actually think for us, those two are uniquely intertwined. I would say this, like the highest edge is going to be the furthest out the risk curve, and like, to lack of a better word, like the weirder sort of aspect of crypto that you're involved in, right? Like all the money, like not all the money, but all of the like very easy money that was around when DeFi first got started was partially just like a function of the fact that either it was very complicated and hard to like know about it, and or it was really impossible to like have traditional pools of capital interface it. And like as time goes on, like those things get edged out, right? Like people see big opportunities and they start to like knock them out, and like they find ways to like structurally be able to like trade on those venues, or they like get compliance comfortable with like, all right, here's a solution and a geo and like a trader sitting in a desk somewhere that like we can use to like get those inefficiencies out of the market. So like the larger, more regulated pools of capital, and this is like always going to be a function of whether or not you have outside capital as well, because when you take other people's money, it's a whole different ball game. And now suddenly you have like a ton of other rules that you have to answer to. And you also have to answer the fact that like you can't just like randomly jump into like the first food farm and lose a ton of like your money, and then you have to explain that, right? Like there's consequences more to your actions other than like, well, that sucked, like now I'm like out that. Like now you have to like answer to sort of people. So you're gonna move slower. So my advice to be, if I could do this all again, I would try to be as nimble as possible and to be playing as far out and whatever is the most like bleeding edge aspect of the market in any given time. What you definitely don't want to do is you don't want to go backwards, in the sense that you don't want to be like, all right, I'm gonna arb CME futures against Coinbase. Like that game's over. Like that's lost. Like yes, there's a ton of volume through it, but like larger pools of money have taken that. Like you're not. Maybe you will be like the greatest thing, but it's a lot lower of expectation that you're gonna like win that market versus be like, this weird thing is happening in NFTs that like 5 guys on Telegram are talking about, and like I happen to be able to get access to them, so I have an opportunity here, and it doesn't take a ton of money, but there's like huge upside on it. Like that's where you really can like sort of make money as an individual, and like also frankly, like if you can keep that pace, like that's like a much better seat to be in my opinion, versus like building this traditional sort of like shop that at this current juncture is always getting harder. So I don't know. The one of the unique things about crypto is it's extremely open. Like you can get to pretty much anybody at any point in the industry with one hop, or like even direct a lot of times. Like it's incredibly easy to get access and information that you need. Like I've said this a couple times. Like you could just hang out in random discords and like make a very nice living just by like paying attention to the information flow and like knowing what's going on. So like that level of like edge like really doesn't like exist in other asset classes as much. Like maybe there's like weird niches of like certain stocks that you can like sort of do this thing, but crypto it's like prevalent everywhere, and you don't need a lot of money to do it, and that gives you the full autonomy to be able to grab whatever you want to do. So I don't know, that would be my advice to somebody that was like looking to get into this, is be like, find some whatever like the bleeding edge of the market is at any given point and just become obsessed with it and try to just like deploy as much of your own capital into it as you can. Like obviously if you like don't have any money, like I mean look, even if you don't have any money you can probably do it, right? Like I mean like there's just like airdrops for money in this like industry sometimes. Like people have like done ridiculous things like that and like turned outrageously small sums of money into like outrageously large ones. So I don't know, that would be my like outgoing advice to anybody who like asks me what they should do at this like current juncture.
Thanks, Dan. And we'll get back to the NFT piece later in the debate section. Bryn, over to you.
Yeah, I largely agree with Dan on that one. I think it's the exact kind of right approach. Just if you're a home gamer and you're kind of, or if you're even a trad guy and you're looking to get into crypto, just I mean, so much information flow happens on Twitter, in various discords, and there's just it has really strong emerging market characteristics. So you're going to find so much edge there. It's almost just comparable to sort of lurking around on Reddit, working out what the pump squeeze of the week is. Like all that same stuff happens in crypto and is far less efficient and easier to execute manually. And I also think we've talked about this a few times in our team, but the tail upside in DeFi, if you actually know how to kind of screw around with protocols, it's just like it's really huge, because you only need to find one thing a year that you can kind of like take a big swing at, and maybe there's $100 million upside, and maybe you don't even need much capital on that because of flash loans. So when I say take a big swing at it, I just mean, if there's a poorly managed massive pool of capital, like the Fade protocol, for example, and if you happen to be able to work out a way to take advantage of that, I mean, you're done for life on that one trade. And so you could easily justify 5 years of lurking around in discords with that kind of upside hanging around. And from the quant side, I would also encourage people to just have a go and just deploy something. Like the barrier to entry is just rock bottom in crypto, even on the CeFi exchanges. So if you take a big venue like Binance or FTX, I mean, you can sign up an account and sort of get an API key and be interfacing with the exchange in an hour. And if you know how to code, it's or you can go on GitHub, and there's so many other people who have already open sourced bots, and just take someone's bot and just actually start running it with $100 of capital, and watch your orders go in the market in real time, and watch what's happening, and just start to think about what you would change in the model or the parameters.
Yeah, I would say on my side, it kind of depends where that particular person wants to end up. Yeah, if it's all about make enough nice money on some opportunities in crypto, yes, there's definitely a lot of them. There's definitely going to be a lot of them in next 1 to maybe even 3 years, just to make like really comfortable living and just retire somewhere. But I guess if your goal is to actually build a company, then you really need to focus on a particular niche for rather longer amount of period of time. And I guess DeFi in general allows for more opportunity there compared to centralized exchanges, because on centralized exchanges already now, like in order to be competitive, you need to generate quite some trading volumes to get to like really nice fee tiers, and it's not necessarily easy like without any starting capital. So DeFi is a bit better in that respect, as long as you can find this capital. And finding the capital, and basically this whole debate against like whether you want to run like a hedge fund or prop trading, like we answered for ourselves that prop trading is the answer, simply because it's like in the long run. Look, if you're in a building stage and you are like running your algos and not making any money, or you're doing something experimental and losing like in some experimental farm, you'll just get redemptions, and that's not nice. And vice versa, like if you're super successful, then this like running a hedge fund would feel like it's a really, really expensive cost of capital, because you don't make as much as LPs. So it's always much nicer to just run your own capital and make your own money. But to get there, you might need to start with some with some capital from like the way Wintermute, for instance, started. Like we did employ some profit share capital initially, and that's what allowed us to grow as well in 2020. But once we got to a level where we knew that we are sufficiently profitable, we basically recalled all this profit share capital and moved on, because there's just like in the long run, that's much better way to do it. So yeah.
Awesome. So switching gears a bit, we had a few debate topics that we've lined up for you guys. So the first one focuses on market structure and price discovery in general. So obviously we've kind of had a significant amount of innovation from a market structure standpoint in the crypto space, from central limit order books to a variety of AMM models to RFQ models, and most recently the time-weighted average market maker model that the Paradigm team and others had released. So with that in mind, kind of from your perspective as a trader and market participants, what are the trade-offs between these types of liquidity models for traders, and are some better suited to certain products than others? And maybe if you guys, as you answer this, if you could sort of keep in mind like what these models might look like at scale in 5 years, and sort of which L1s are they being built on, and also how you think about that from a price discovery standpoint. So with that said, maybe one of you that has a particularly strong view or kind of background on the TWAM, if you want to kick things off, that'd be great.
Sure, I'm happy to chat about that. I'll try to keep it high level. I still have some questions about the TWAM blog post that I wanted to ask Dave, but I didn't want to ask him until I've checked with my team. Just trying to tap our local resources first. Yeah, in terms of AMMs, I mean, the first time you hear about the normal kind of XYK AMM model, you think that it sounds very elegant, and it is, and it has a lot of kind of nice properties to it. But I think coming from a trad market making background, it becomes apparent quite quickly that it's a really poor kind of way to model reality. I suppose it's like if you were trying to be a market maker yourself, and you decided that there was a single input to your model, which is how much size is being traded against me, and nothing else mattered, and that's like really bad. Like you'll lose a lot of money really quickly. I mean, having a market making model with no price is just a recipe to get run over immediately. So obviously these things have been evolving, and people are trying to evolve them, and I think that's noble. And one thing I think is I sort of keep coming back to this similar thought process. Like every time I see someone make an iterative improvement on XYK AMM, so changing the shape of the curve or trying to add a feature or add an input, I feel like the steps are too small, and that people are maybe just missing the forest for the trees. Like they're focused on these really micro iterations when the end goal is already known, which is kind of like a fully featured order book where people have all the information and they can decide what types of orders they want to put in, where and when. Now that being said, the really most elegant thing for me about AMMs is that it allows retail or kind of passive capital to play the role of market maker. So yeah, I don't know exactly how the future looks, but if there's some way that somebody maybe more closely aligned to ourselves or another sophisticated market maker was to kind of design an AMM model with maybe 10 to 15 features that actually capture the things that matter in terms of liquidity provision, and then we're able to open source that or to place that on a protocol and allow passive capital to be the funding pool. I think that would be really successful and suffer a lot less toxicity. It's non-trivial for sure. I think it probably needs to interface with an oracle. I think it probably needs to operate on a chain that allows pretty cheap compute or fast compute, so that you're either talking about Solana layer 1 or a reasonably efficient layer 2 on Ethereum in those two ecosystems. Yeah, the TWAM thing, I don't know. I'm a little confused about it, because it seems to me that it's more of an order type that's being applied to an existing AMM. So, the name TWAM sort of implies that the AMM is different, but as far as I can tell, the AMM is the same, and it's just it's a new feature, which is you can do this TWAP order type. And so both of those things already have names. The order is called a TWAP and the AMM is called an AMM. And I'm not sure why they're being conflated here. And what happens, what happens in the future when you try to add the next order type? What if you want to do a VWAP? Like, do you have to rename the AMM? But yeah, it's all just a working paper, and I think it's definitely a problem that's being faced right now by a lot of people, ourselves included. Like, it is very annoying and difficult to execute large size on less liquid DeFi pools, and so hopefully someone can come up with a neat implementation of a TWAP or TWAP-ish feature.
Yeah. Like on my side, I kind of view it from a more general point. Like, if you look at traditional finance, it's basically trading in traditional finance. Like, one way to look at it is basically market makers fighting with informed flow, like, I don't know, funds basically. And in that regard, like, well, and market makers being this like huge HFT firms like Citadel or Optiva. And they're kind of winning, especially if you look at retail side of things. You see those like Robinhood Citadel combinations, which basically completely take over pretty much most of the flow from US exchanges. And if you look at the institutionals and traditional finance, it's like all institutional trading. It's either going like via very liquid derivative exchanges like CME or Eurex, or it just goes via OTC desks or like via OTC platforms like Bloomberg RFQ. And I don't really see a reason why crypto would evolve in a different way. Like combinations of platforms or protocols like can be a bit different, but I totally see, for instance, a combination of Paraswap or 1inch being in the role of Robinhood effectively, or like Zerion, for instance, being in a role of Robinhood and basically connecting to all the liquid AMMs and a bunch of market makers. And like this is a completely valid model that can work for spot and derivatives and what's not. When it comes to MMs and like the TWAP MM, I really don't see how it's, I basically, kind of like mirror Bryn's thoughts as well. The business of market making is just so complex. It's way more than just like 10 or 15 or 20 parameters in it. And if you're a successful market maker and you have this like secret formula that makes you money, why on earth would you release it in an AMM way instead of just making money for yourself? And I think that's why it will be quite a few years until we see any like significantly complex and successful implementations of AMMs. And on the TWAP specifically, I'm kind of not very bullish on it, simply because if you do a TWAP, you don't want anyone to know about it because you can be front run. And so far, what I've seen from the paper is like the way they want to address it is they basically want people initiating TWAPs to basically do some market manipulation, and basically pretend that they're buying and then screw the people who are front running them. And I think it's just like kind of poor design because you just want to use TWAP, you don't want to manipulate markets and screw with people. So I think those TWAPs, I actually would be really interesting how they're getting taken by, well, for instance, RFQ platforms like Paraswap, like if they can implement this kind of functionality and do it in a hidden ways that the whole market doesn't see, and just like query a bunch of market makers to take it over. I think that would be a much better model.
Yeah, I feel like this is like such a flame war in crypto, and I don't know why. This whole order book AMM thing always getting rehashed. It's just like odd that like the people that do all the trading like feel that the order book makes the most sense, and they like, at least in my opinion, have like laid out very good reasons about their business that they know the most about, and then like it's everyone else like fighting at them that they don't know what they're doing. It's just like a very interesting. We're like not completely impartial in this thing, right? Like we've backed Serum, Solana, like Pipe, like Switchboard. Like we have a lot of like bets in the idea that like this is going to ultimately land on an order book model. So like that is like very much like where we see the end state of all this stuff. But like and I was very dismissive of AMMs out of the gate, which was wrong. I will make one little caveat to like what some of my colleagues said here is that like I think they actually have been very successful. I mean, like there's billions of dollars in TVL and like people are using them. They're moving like real volumes. But I think that's primarily a function of there's just a lot of capital in the system that like wants to earn yield and like has incomprehensible risk tolerance, right? Like so there's like somebody who has like ETH and Bitcoin and they're like, I'll just put in this pool. Like, what do I care? Like if like the like ratios move around or whatever. Like I'm happy having more ETH or having more Bitcoin and like I'll take the path dependency and like maybe I'll earn a little bit. Like in that pool of people, like I think has largely not like there's been like opportunities for like this stuff and you can obviously lend it bilaterally and like whatnot, but like it's just been very easy to like slam it in a pool and like leave it and like be like, oh, that's cool. And like that's stuck, right? Like people love this. And like obviously like yield farming related stuff is like jacked up a lot of this, like across like different stuff. But that's that whole subset of people, like I think if any order book design in the end should find some way of incorporating that desire like into it, because like that was clearly like a tapped demand that like wanted to go out there, and like maybe that's just like a better way of like click lend and like maybe juice it if you like are willing to take some like risk on some like bound of like some effective like option that you're like selling or something. So it's just like that coming in is like I think the big takeaway. As far as the TWAP AMM like model and design, like I am just skeptical still of anything large that matters being executed on chain in like the current design. Like it's just I don't know, like the fact I still think like most of the liquidity is like off that for sure. And then like beyond that, there's just too much information leakage like across the board. Like I'm not entirely sure how you would do something material and real without like not only like people that want to like argue taking it out, but just like having Twitter like all over it, like yelling like within 30 seconds. And like that's just like not a good design. So like I'm just like skeptical from that. But in the high level mechanics, like I haven't dug a ton into the depth of it, but I would bet that there's just better options currently out there if you're like looking. I mean, we do like execute large slugs and like we have better ways generally of doing it. I mean, like if you're obviously the market maker, you have a really good way of like doing it. And I think when Wintermute did that Shiba trade, they like were very like transparent about like how they're doing the whole process. I thought that was like a really cool sort of breakdown. Not I don't know if that was like officially a TWAP, but or it was functioning effectively like sort of as one in a capacity. So I don't know. That's why I fall in the whole thing. I do think like order book stuff, but I don't want to spend a year fighting about it on Twitter. So don't come at me about it.
Yeah, makes sense. If you guys had to kind of comment on where you see price discovery coming from, say a few years from now, let's say the market's more built out, both in DeFi and CeFi, and you have a variety of product types out there. Where do you guys see kind of the market pricing being led from?
I think the trend's your friend on this one. I think it's going to be the perpetual futures will continue to just dominate price discovery unless there's like a regulatory shock that forces that to go away. I think that's like, especially now that you're seeing those instruments dominate things beyond just like the larger cap names. Like, I just think that's largely where you're going to see like price discovery, especially like in aggregate, like risk of like, if there's any like sort of like macro pulse to crypto, like that's where you're seeing that stuff sort of like play out in. I don't know. I don't think that's going to change.
Yeah, I mostly agree. Over the last kind of 3 or so years after we started looking at crypto stuff, we had a number of models which were pretty, quantitatively keyed into all the different venues and liquidity sources, and there have been changes or evolutions over the last few years, which venues or products lead price discovery, but for a long time, it's or a good rule of thumb that will normally work is just where is the most liquidity being transacted, and that will generally lead you to the leading instruments that are driving price discovery.
Yeah, I agree as well. It's like that's what you see in traditional markets as well, where the futures products are basically driving the price action for pretty much everything. I think like the only difference could be like in less liquid tokens, for instance, like in the long tail assets, which might not be able to accommodate any kind of derivative market. And so that's what you see, I guess, in single stocks as well, and TradFi as well. But for anything like whatever top 20, top 30 tokens, yeah, derivatives will definitely lead the price discovery.
Gotcha. And kind of the last thing to touch on here before we switch over to the second debate topic, if you guys had to kind of comment on what you see the future of dark versus light kind of OTC pools in, right? Like where in traditional markets you've had the development of these dark pools where a significant amount of volume trades, and also a lot of these OTC platforms, similar to kind of to how you were extremely active in early on in crypto, Dan. And so if you guys are looking at that and sort of looking at the future of crypto and DeFi, of course, extremely transparency focused, do you guys see volume ultimately all moving towards these lit pools effectively in DeFi, or do you still see a role for kind of bespoke and kind of hidden OTC pools?
I don't think there's enough end order flow that's looking for that currently to justify it. I think it's a tremendously retail dominated market still. And I think that like gets missed and a lot of people that try to like build these products out. Like I think the current setup, like look, if like you want to sort of like hide something, I mean like you can just like route that through an OTC desk and they'll like internalize it half the time anyway if it's like a large cap. Or like go to any one of these other guys on this panel and be like, hey, I want to do this. Like, you want to work with me? Like, there's options, and there's not. Like if you built a dark pool for like pretty much anything but the top 5 names, I don't think there'd be anybody using it. Like, there's just not enough like people looking for that at any given point that are willing to pay for it that would use it. So I'm look, there's a world that could get there. I just don't see it on the horizon currently.
Yeah, I don't have a lot to add there. I wasn't exactly sure what we were talking about. I mean, yeah, dark pools in TradFi were kind of a failed experiment in my mind. There was a period of time when there was a lot of literature and buzz around them, and it doesn't really seem like any of those things stuck or attracted a huge proportion of flow, even though they hang around. And I'm well, depends what sources you read, but I'm reasonably confident the balance of research about dark pools is that the execution is less good than a lit market.
Yeah, I think pretty much agree with the guys as well. Like the only thing, like it would be really interesting if somebody figures out a way to direct flow to lit pools in liquid names, but make it not very obvious, because the whole problem and the whole reason why people would go to dark pools or to OTC desks for that matter is just nobody want to leak information. So if somebody figures out a way to basically direct this flow on DeFi platforms without anyone on Twitter noticing, I think that would be quite an interesting product to build.
Great. Switching gears now to our second debate topic, and this relates to one of the comments that Dan made earlier around NFTs. Somebody just posted a rare CryptoPunk NFT for sale for $90 million that, if accepted, would become the biggest CryptoPunk sale ever. The NFT was previously sold for $7.6 million, so a very significant increase in the listing price. I was curious to hear your guys' thoughts on the Punk's price action over the weekend. There's a whale that's been buying up some of the limited supply. And do you guys see kind of NFTs and in-game assets eventually becoming attractive or liquid enough to get involved in from a trading or market making standpoint?
I can touch on that first if that's all good. But I think it's like I understand you're just introducing the topic, but just to make sure everybody is on the same page that when you offer something in the market, the ask price is not the traded price. So it's like titillating to see a $90 million ask on a CryptoPunk, but I too have listed an NFT for $90 million, and I don't think it will sell. The Punk might though. It's interesting that you asked the question, will it ever be liquid enough to get involved in quantitatively, because we were already doing that in February, and I think we were probably one of the earlier and more professional firms to be doing that in the NFT space. That's a little more in our wheelhouse, like maybe more opportunistic, nimble kind of stuff that lends itself nicely to scripting things up quickly, but maybe sort of throwaway scripting that you don't intend to build out into a massive system. And I can give some specific examples because we're doing a lot less of that now. It kind of became less interesting. Maybe this month we should get back into it. We used to we did a number of sort of snipe bots on assets with fairly established price floors. So there was a long time or a couple of months when there was fairly frequent like fat finger order entry errors on OpenSea. I actually think a lot of that was from people trying to go direct to the contract to enter the price. So it's probably, if you've ever tried to trade an NFT or kind of played around directly with a contract on the Ethereum blockchain, there are various kind of decimal place rounding issues that you need to deal with. And I think on a lot of these NFTs, there were like either 9 or 16 decimal places. And so if people are off by 1 when they enter the price, they'll sell you a punk for 3,000 instead of 30,000. And if you're the only kind of bot who's listening to the blockchain for those specific assets, then you can do just pretty well every so often, doing sniping those things to buy them. We also just played around with some other fun concepts at the time. We had valued all of the plots of land in a few metaverses like Sandbox and Decentraland, and this isn't a super new concept, but it's just the same as the real world real estate market. Like most real estate you can estimate the price of it using quantitative inputs, and all the same principles apply to the metaverse land market. That there are just location matters mostly, and then there are certain features about location that matter more. In Somnium space, for example, is it a waterfront plot? Like what's the maximum height you're allowed to build, etc. And so you can just build even like a basic regression model and then just set up some bots to try and snipe land that's underpriced. And one other big thing we went into was this the first copycat of the CryptoPunks, which was the Binance Bunks. That was just kind of heard about that one night on Twitter, and then the whole team was there just manually clicking it in before they sold out, and we got a few hundred of those things and kind of were able to flip them. But yeah, I'm not sure that at the moment, or maybe ever, there's kind of enough juice there for a big trading firm like us now. Like we have too much AUM to sort of be screwing around for a few $1,000. So I think that's another great example of like a reasonably kind of real and doable edge for someone who might be on their own, or a pair of coders or a pair of people trying to learn the space. But yeah, maybe won't be attractive enough for guys like us anytime soon.
Yeah, for us, it's like we are not even as we're definitely not as deep in NFT space at the moment, and it's primarily because we don't like, it's just not attractive enough for us to bother with it, because like there is always like a lot of opportunities and mispricing, but like just like Bryn mentioned, like a lot of code is thrown away, and we are primarily focusing on coding stuff that hopefully will still be reusing in like 6 to 12 months time. But on the NFT front, I guess like two things I'm kind of looking forward for us to get involved in is, I guess, first is if somebody starts running those, kind of like funds of punks, whatever, and there will be derivatives of them, and then it would be actually possible for us to make markets on them. And second, like digging really, really into metaverse stuff, like once you have, I don't know, like once you have like enough in-game assets that it's actually like it's sufficient economy for us to get involved in as a market maker, that would be pretty cool as well. But I don't think we are there yet, and I think it will be like at least 6 months till we see some significant volumes going through in any of those metaverses for us to get involved as a market maker. But that would be really cool.
Yeah, this is like a really good opportunity set, like what I was touching on before, for like somebody to like carve out a very good living, just like knowing all these intricacies of like even just like all the punks and like playing around. Like there's just like dropped money everywhere, like all kinds of random things. But like to get to the point said before, like it's not enough money to do like systematically for size that like I think shops that are larger like can justify like doing. I think if there were ever to be anything we would get involved on this front, besides like investing in sort of infrastructure that would help these like tools or pieces of like the ecosystem, would be if there were like any index like sort of related products that were like kind of liquid, right? Like there was like some way of aggregating trailing sales of like punks to like some instrument, and like if it was tradable in some fashion for like size, like in aggregate. I mean I don't even know entirely like what that would look like necessarily, and I know like some people have tried some things around like NFT sort of related indexes. It's just like hard, right? If there's like 10,000 punks and like you're effectively like picking up pennies trying to like figure out little like arbs between all of them at any given point, or like why stuff is like systematically priced or underpriced, it's just like hard. I mean, you could take like a big slug and just like buy it for like outright risk, like that's definitely still like in the cards, but like just trying to like trade them, it's hard. So, but like that being said, like this is a great example of something that, like, look, I was personally like dismissive of this, not like dismissive, but I was like, this is cute, but like I don't really care. And like the money got real fast for like a lot of it, and like I saw it, and like I even saw like the evolution of it as it was going through, and like I'm sitting right here. So I mean, also the idea that like there's like always smart money like doing this stuff, or like that knows what's going on. Like sometimes you just have no idea where like stuff is going to like grow out of, which like gets back to my original point of like just pay attention to like the cutting edge of it all, because you have no idea like what's going to like come out of this stuff at the end. Like I am very, very interested though in like how quickly I don't want to say mania, because that implies like it's like mispriced wrong, and I don't necessarily believe that, but just like how fast things move in crypto, that like it's like ubiquitous now. Like, oh, you got a punk, like you've been around for a while, or you're smart, or you get it. Like it's just like I feel we were only talking about them realistically 8 months ago, and now it's everywhere. Like you're seeing them in like auctions. It's just the pace is outrageous to me of like how this stuff. It's great. I love it. Like, but that being said, like the things that flow through people and like their like risk tolerance and like their momentum and their speed and like the way like stuff like gets adopted and like all of those like things that happen in CryptoPunks or just like NFTs in general, like that same sort of ethos runs through all of the other aspects of like crypto. And like that's like why you see things just like happen at such like a large, fast scale. And it's like worth paying attention to, because it's no different than any of the other like cycles or things that we've seen like play out in this industry.
That's great. And I guess just to follow up on that point, Dan, I mean, do you think that crypto has a worsening liquidity and attention fragmentation problem? And how do you guys kind of get over that hurdle more broadly?
I mean, like we get over it by like we just like haven't done anything. Like we just like haven't interacted with it, mostly because like it is like harder. I mean, like I think it's like probably also the reason I don't know a ton about this. Like, but are there like funds that trade art? Like I would guess probably not a lot. And like if they do, they're probably very small and like boutique in themselves. Like it's just like it's a hard asset class to be like shifting around risk in, or like where expected value changes of like future prices are like actionable. So I don't know. I would bucket them in the same thing. Like I'm not dismissive of them. Like I actually find the whole thing like very cool and fun. Like especially like as an onlooker of it all. I just like it's hard as a trading asset for us to have much to do. Like there's guys on the desk that are like very deep in this stuff and like are talking about land auctions and like all kinds of crazy stuff. Like sometimes there's been a couple of trades we've gleamed off that if there's like a native token that has like a purpose beyond the actual like NFT, but like otherwise like it's still like really hard to like have anything to do from a risk side.
That's great. Thanks, guys. Great thoughts. I guess just to wrap things up before we turn it over to the audience for a few questions, we have kind of two closing questions. So the first is, are there any exotic perpetuals you guys would like to see in the market, or anything specific in DeFi?
For me, the one thing, like if there's ever going to be a chance that people really want to trade volatility stuff in DeFi, which we haven't seen that appetite yet from end users. I really want to see someone do a clean implementation of just like a realized volatility future. If you can work out how to implement that nicely, it's so much simpler to understand for traders and people looking at pricing, and it's kind of easily scalable to any number of assets, no matter how illiquid, because the only input you need is the historical prices.
I would love to see more index products. I'm a little selfish in this regard, because here's like a problem that we find ourselves in a lot of times, right? Like we have like obviously risk parameters that we like keep ourselves in like any given point. But like let's say I'm like, all right, I think we should buy a ton of ETH here, or like I think like there's for whatever reason, like ignore like the purpose behind it, but like we want to get long ETH. I want things to sell against it so that I can like do that trade larger, right? And what the problem is, like you can use the index futures on FTX, and like those have been a big use for us, but like they phage on the funding really hard. Like they're not that liquid. Like people aren't in it, and like they're clunky sometimes in the sense that like a certain name will like dominate them, which like is not great for us. Like I really want to see a good index product that the industry can like lean on and use for trading purposes. It's just like a way to like hedge beta out. Like we used to do this with spiders, like obviously when I traded equities like a million years ago, but I would love to have like something like that. And like if it was DeFi native, like even better. Like if it was like, all right, you can only like access this stuff, or that's where its pricing indicatively came from, and like all the exchanges just like keyed off that and like did funding based on it. It'd be great. So I don't know, that would really be what I want to sort of see out there. And I'm not even entirely sure like what my optimal design of what it would look like would be, but I would love to see more use of things like that. This like also gets back to like the NFT thing, right? If there's like some sort of indexable component that was like liquid and tradable, and I know some people are working on some stuff out there, but like at least getting them actionable and people like trading on them would like help too, so that there's like liquidity. That's like a big thing I would love to see out there.
Yeah, I really second that. Like we really want these index products to be, well, we're trying to push them as much as we can on all kinds of exchanges that we are talking to. And in general, like, yeah, if we could invest into whatever, index on Solana or ecosystem, or index on whatever, Polkadot or Polygon, like, it's just such a big opportunity, I think, in general. And yeah, somebody should just list that. And I think there will be like a lot of interest from both the buy side, well, as you just heard, but also from the sell side, like, well, we as a market maker would love to make markets on those products, and it's actually like, well, I think those products will be liquid and they actually be a good substitute for the market in general, and be a really good hedging instrument in the long run.
Perfect. So just to close things out, we're going to have a FUD or signal rapid session. I'm going to say a few themes that are prevalent in crypto, and then we'll walk through one by one and say whether you think it's FUD or signal, and then a short explainer why. So to kick things off, ETH2, FUD or signal?
So I'll take this. Not giving directionality on it in any like short term, like I would say it's like signal, right? Like I mean, it's incremental progress in the right direction for ETH. Like it's a big deal. Like I to be dismissive of it in the sense that it like doesn't matter for the price at all is definitely wrong. That being said, like this is like where it's like, right, like you may think something has signal, but you may think that like the market's like overpricing like said signal, right? Like you got to remember, like everybody wound up on ETH, and like there's a reason it's outperformed the shit out of BTC over like the like trailing 3 or 4 months because of like the back of this. Like that's part of it. So signal, but like not necessarily like means it's going up. Does that like answer your question a little bit more? Like I think it's relevant like to ETH and definitely relevant to like ETH's price going forward. But I worry that like it's a wound up trade that's already gotten crowded. And I think you did see some of that in like the washout that happened. I think it was a little more like exacerbated in ETH because like there was just so much like levered up like into that like sizing. Which maybe like helps now that are like on the backside of it, right? Like maybe it'll be on their own. I think it's gonna be interesting to see how the burns start going. If they're like higher than people think, like then I think it's gonna really fly.
Yeah, I would say like, well, at this stage, closer to flat for me, because pretty much for the same reason. Like I think it's already been priced in multiple times, and like nobody knows when it will actually happen, and it's so from that perspective, it's just like a fact to me. Like I don't take into account in my assessment whether I want to buy or sell Ethereum, for instance, and I don't think anyone does really, like, because it should be priced down by now, and any talks about it, it's more like, yeah, when is it going to be finally coming? But like it's you see already like all this huge ecosystem around staking instruments, for instance, with Lido, for instance, and like this stuff is happening. Like there is a lot of value locked into it. So yeah, like any like additional news kind of fun to me, I guess.
Yeah, I don't have a lot to add there. I kind of agree a little bit with each of the guys. Short term, it's definitely a signal that's moving prices. Crypto prices seem to be pretty reflexive in the sense that, or even, which sort of leads to momentum. So whatever is hot continues to get hotter, and so I think in that sense it's hard to price in events a little bit. It's not impossible. Like I think the Uni V3 launch was like super priced in. That was a pretty easy like post event short. But this ETH thing, I can see it going either way. So I don't want to draw a line in the sand.
Great. Next one is the U.S. infrastructure bill and its impact on crypto. FUD or signal?
I think
on
you go.
Quiet, Dan. I think on that one, just signal only in the sense that it's part of a broader regulatory shift and has been happening for a long time and probably will continue to happen. So I don't think that bill itself is sort of like super important, but maybe it is. It's not my area of expertise. I'm not like Niraj over at Coin Center or one of those people who's deep in the regs.
There we go. So signal, but I'm going to ignore the regulatory side of it. I think it's just like the continued pattern that they're just going to keep injecting an incomprehensible amount of money into the system. And I think that's the big takeaway here for like all asset classes, and like crypto's just going to get dragged with it, kicking and screaming. Like this just isn't going to slow down, right? Like there's just like this idea that like there's going to be any pulling back or like fiscal responsibility is like pretty much gone, at least stateside. I think this is just showing more and more of this like coming through. So like I'm excited as somebody seeing trillions of dollars like move into sort of the ecosystem, and the ecosystem being the US economy, and then like somewhat whatever small piece of that hits crypto, I think will like matter. So I don't know. That's in the regulatory side, like I said, I don't know, but I think this stuff tends to usually just like work itself out.
Yeah, I feel like we're going to agree on pretty much all of those points between the three of us. Yeah, I think it's definitely part of the bigger like regulatory pressure framework that, yeah, it's really hard to see where like how big of an impact it will have, but it certainly will have an impact on, for instance, like number of institutional counterparties moving into space, because they might be like worried that a particular bill might hit them or not. So from that point, like the more of those bills you would have, the more it is of a signal to me, to be honest.
Great. Next up, minor extractable value, MEV, FUD or signal?
For me, I don't know. I'm kind of like a little fatigued about hearing about MEV. I feel like there is a lot of discussion about it. I think, I mean, it's important to understand and to work out, but yeah, I don't know. I feel like it's a big black hole or a big sinkhole of a lot of smart people's energy, which is kind of not super productive.
Yeah, I'll just touch on it, Ed. It burns a lot of resourcing for us for problems that like we don't want to have, right? Like it's just like this endless, I don't know if it's endless, but it seems like it's just this constant cat and mouse nonsense that we do. That being said, I mean, it's cost us real money. Like I think we lost close to $1 million just in like sandwich attacks, like when we finally like got around to like fixing the problem. But then it's like, all right, like you fix the problem and then there's a better mousetrap and then you got to like fix that. It's just like, it does seem nauseating. Like nothing gets built at the end of it. You're just like constantly sort of having this arms race. It feels like a little bit, I guess, like the race to speed and HFT sort of things as an analogy. But yeah, I mean, it's real. Like, I don't know enough about ETH's roadmap to know how any of this stuff may or may not change, but I'll tell you, it does like burn real resources and like money internally, which is like, so it's real in that sense.
Yeah, I think the analogy with high frequency trading, like arms race, is very very, very correct, because it feels like exactly what, like when I was at Optiva, what we were doing, what other market makers were doing with like first like cables and then microwave towers and like radios bouncing off atmosphere. It's basically the same thing. It's just like a lot of wasteful spending, a lot of waste of time going into it. But I think the good thing is it's kind of like the guys who are behind any of the network, behind any of the protocols, whoever is building Ethereum to they can take this into account, they can fix it. But it's also like we actually could have predicted this would be happening like years ago as well. So it should not be like a massive surprise to anyone that this is happening.
Perfect. And then the last one is L2 growth versus other layer ones like Solana, FUD or signal?
Don't know how to categorize that exactly. I think like it's kind of a no-brainer that ETH as an L1 is not sufficient. So L2 growth is a good thing, but I don't want to make a strong guess about whether Solana or some ETH L2 is the emergent winner in 5 years' time. Could go either way.
I think you could have both. Right. Like you're gonna have L2s that like move some like real volume through them. You're obviously like, look, you have like L1s that are at least gaining value for like in aggregate. I think you can't like be dismissive of that. Whether or not like you can say, well, the economic activity on it is like true and pure and like matters or is like competitive. Like that's like a harder, I think, sell right now. Here's what I think is gonna be like an interesting problem L2s are gonna have is that a lot of value for these ecosystems is driven just around the fact that their L1 has value. And like what I'll expand on that a little bit is like people care about ETH because they care about ETH's price. And like they care about like they're vested in it, right? And like it'll be the same thing for Solana or AVAX or Algo or like whatever, right? Like a lot of these L2s, there's not necessarily like a clear value prop for using the L2 or like that you're like invested sort of in it. And like that may seem like a sort of irrational economic like argument, be like, why do you care? You're just trying to like get stuff done. It's like a lot of this industry is just like built on that concept of like I own this and I use it and I like appreciate in it and like I want to see like do it. So I think that is like a weird problem that L2s like may or may not find themselves in when they're like competing against like other L1s. But I really do think you're gonna have both because like ETH is so strong and people have so much like value tied to that they're gonna like want to build things on it and keep those things running and like use those things that are like bolted onto it to like make sure ETH like maintains some dominance. So I think that's like sort of how it plays out. But you're just gonna have both.
Yeah, to me it's kind of two problems there. So first is like there is a really big fragmentation of liquidity on the spot side of things with all the different L2s, with like Solana, like it's just like the more L2 solutions you have and more like L1s like Solana you have, like the more fragmented liquidity will become. And I think it actually plays really well into derivative kind of products because they don't care. So you can actually continue developing them and then speed is the only thing that matters. And the second thing is everyone is talking about like how fast you can insert transactions, but I think like the real problems that we will start seeing like both in L2s and L1s and like in any like fast chains is basically like reconciling everything because we actually saw it ourselves already on Binance Smart Chain because they were like so smart that they copied Ethereum but made everything faster. But now it's like very, very unusable because it's really hard to read it. Like it's really hard to sync your nodes if you are running your nodes, and it's like a real problem. And I'm actually quite curious like how all these L1s and L2s will solve that as well. And I think that's something we should be watching as well.
Perfect. Dan, Bryn, Evgeny, thanks so much for your time. That wraps up our prepared questions. We have about 5 minutes or so for the audience. So if anyone has any questions, please raise your hand and I can bring you up on stage.
Hey, hope everyone can hear me. Sorry, this is my first time using Twitter Spaces and I'm still getting used to it. But thanks for the great conversation, really insightful. I work for a firm that provides back-end crypto services to retail brokerages. And one interesting kind of, I guess, development we've seen recently is obviously a lot of demand from retail customers for altcoins, like Shiba Inu coin, Doge, just, ones besides like Bitcoin and Ethereum. And as we start to try to explore finding market makers and liquidity providers for some of these altcoins, it's been proven to be pretty difficult to find some that are some of these more institutional and retail or institutional liquidity providers that have the capability to provide liquidity for, Shiba Inu or a Sushi Swap or something like that. So I guess my question is, do you see, some of these bigger DeFi options, being able to provide that, kind of filling that space to provide liquidity to more institutional in retail firms like mine, because that's an option that we've looked at. But I think the problem is just from a compliance and risk standpoint, it's just kind of hard to do AML, KYC, and stuff with more of these DeFi options. Hope I explained that well. Thank you.
Hey, Michael. Bryn here from MGNR. Yeah, it's interesting. I'm not sure exactly how far down the totem pole of shitcoins your clients are going, but I think at some point it's a reality, or we need to accept that it gets less and less likely that big institutions are going to be market making certain types of coins. It kind of reminds me of one time I had a person come to me via Twitter and said, hey, I know a guy, and he's made $6 million on this shitcoin, and are you guys able to give us a price so we can get out of it? And I forgot what the coin was called, but it's something ape. And I pulled it up, and the price was sort of 0.0000001 at 0.00002, and his entire net worth was dependent on getting filled on the ask instead of the bid, and there was $6,000 of turnover a day, and so if you get that far down the bottom of the barrel, like the reality is you're never going to find a way out institutionally. And I don't know if you guys can interface with directly with Uniswap, or if that's what you were implying you already have set up, but that's probably your best bet at that point.
Yeah, I would say it really comes down to like how far, what's your risk tolerance on the regulatory side of things? Because if you do need to have like hardcore KYC AML and like especially if you're regulated, you need to be you cannot be facing probably the hardcore DeFi, and like you cannot like interface with Uniswap or whatever one of the aggregators. Like it's not going to work for you. So then your only option is basically try to work with a market maker, and you can drop me a DM after this session as well. We can explore how we can potentially help there. But I can tell you already that the market makers that cover this like long tail list, they will not be like super hardcore regulated by all kinds of regulators, because they're actually trying to be much more nimble about it.
Yeah, I mean, like as a rule of thumb, I would say like once it has like a perpetual future on Binance or FTX, it's probably fair game that a larger market maker you can face will trade it.
Thanks, guys. Brett, over to you.
All right, thanks a lot. And enjoy the talk so far. So I have a question on kind of DeFi blending in with real world assets. There's been like I think like a really early stage trend right now to bringing real world assets on chain, like tokenizing, like pools of mortgages or invoices, kind of assets from the real world. I've always kind of had a thought that we'd see like public stocks and real estate and other kind of mainstream securities tokenize on chain. I'm curious if you guys think this trend is inevitable, and then also maybe kind of what some of the barriers are, and then also I know you guys are talking a lot about derivatives. If we'll see kind of perpetuals on chain for stuff that's kind of not crypto native, like this is some of the stuff that FTX is launching, like lumber futures and that type of stuff. If you see traditional assets as a growth area for DeFi. Thank you.
So I'll say this. I will say that I think there's an inevitability of like a blending of the two worlds, but I would say that it is going to happen in a much longer time frame than like anybody predicts. Mostly because things that exist in the real world, like first of all, they've been around longer and they have very dominant entrenched regulatory regimes that are going to be very hard to move into crypto, specifically because and also like it doesn't jive a lot of times, right? Like everything in crypto, not everything, but a lot of things are just like bearer assets, right? Like if you have them, and that's like the end of it. that's not like true of a house, right? Like if I put my house on chain and somebody like steals it, like doesn't really matter. So things like that are going to be like a little incongruous at times with like portions of like how the system works, like in DeFi. And also there's just like such a complex like setup of like regulatory bodies that oversight all of the things that like exist in the real world currently. It's going to be very slow. I mean, I think the things that are quasi tokenized already, like stocks, are probably the easiest one that you can see an analog to putting into something like crypto. But like, look, like there's like a lot of rules around like touching securities. Like our industry in general does like a lot of work to make sure everything we do doesn't look like a security. So it's possible, and I do think it will happen. Like I'm a buyer of that thesis longer term. I just would not hold my breath that you see this in like the next 5 years.
Yeah, definitely. Thanks, Dan. Maybe just like one quick follow up on that. Like, what about something like I mean, Elon Musk, right, has been in and around crypto. I mean, like what about like, tokens like NFTs representing like automobile pink slips, right? If or kind of stuff like that just brings more of the real world into DeFi. Do you kind of see some of that happening maybe nearer term?
Well, the NFT stuff seems to have like a ton of traction because that's like in general stuff that isn't in some regulatory like regime, right? So like you have like sort of open ability to do it. Like I think that's like why you see so many U.S. corporates and like we're just corporates in general like on embracing that in some capacity because there's not like a ton of risk involved in like doing so. I'll tell you what, like no entrenched incumbent is going to do anything to like put their existing businesses at risk for crypto, for something that has like an unclear market like opportunity, like unless you have like a very very like sort of aligned management team that like views this stuff as like the future and like wants to do it for reasons that are not like rapidly transparent, like why the economics would be there. Like I mean like a sailor type situation. So I think that's like sort of why you've seen like upticks in like creative sort of related stuff and like NFTs coming out. It's just like look, like nobody wants to like rock the boat to like put their existing businesses at risk if there's like an unclear market opportunity.
Yeah, definitely. Yeah, I can pass it on to the next question asker if there's somebody.
Hey, can you guys hear me?
Yes.
So thanks for the great conversation. There's a lot of good information passed on. So I was just interested in hearing your guys' thoughts on moving crypto to like the next level of consumer adoption. I was, watching Vitalik speak at the conference about a week ago, and he's around the boat. Obviously, like DeFi is great, but like what's past that, the benefit towards consumers, like earning a yield is awesome, but most people don't really care about that who are just everyday consumers. And obviously we have gaming taking off on chain, and I'm just interested in obviously NFTs. That's a whole different ball game, but what do you guys see in the future of bringing consumer adoption to crypto?
Thanks, Jordan. Yeah, good question. I think most people would agree at this stage, DeFi and crypto is still very geared towards crypto native users and power users, and I think something that's actively being worked on by a large number of teams, and is probably the focus of a lot of Silicon Valley venture investment at the moment is ways to improve UX and UI such that they can face retail consumers with no strong knowledge of crypto. I've seen a few other real world examples of things kind of crossing over between into crypto lately. I mean, the Lollapalooza that just happened in Chicago, I'm pretty sure I saw like it was definitely sponsored by Solana, but maybe they actually had a merch store or an NFT store online, and it's very easy to see the leap to doing concert tickets and other as someone mentioned earlier, things like pink slips and such on a blockchain or via NFTs. I think also this one's a little bit more under the radar, but I believe there are a number of apps that are being built on the Terra blockchain that are doing a better job of being consumer-friendly, consumer-facing apps than anything I've seen on the ETH or Solana side so far. And I don't know, all of the kind of background behind that, but it's if you start digging around some of these things on Terra, like they're just really nice. Like the UX that they have, apps that look a lot more like Acorns or Robinhood, and you can just imagine pulling them up on your mobile, and it just sort of says, here's how many dollars you have. You can make this many dollars of interest, just without people needing to understand things about blockchain and MetaMask and all of that.
Yes, I think like to add to that, I think it's all about the gateways. So currently you have Coinbase, and FTX now is really active as well on getting this like consumer interest in crypto, and I think it will. Those are the like companies you should be paying attention to in that regard. And I think it would be quite interesting if somebody interfaces properly with DeFi, potentially bypassing like Coinbase and FTX, and I don't know, Circle can do it, for instance, just like allowing people to go directly to a nice UX of whatever Terra or like some UXs on Ethereum as well. I think those like UXs, those websites is what will drive the adoption from the retail side of things.
Thanks, guys.
Okay, so I think we have time for one last question. Dima, the floor is yours.
Thank you. I was wondering, what are your thoughts on options? Specifically, I recently saw an article from Paradigm on everlasting options. If this has a place in crypto, and what are the advantages compared to perps?
Yeah, I've discussed that everlasting options paper with a few different teams that we work with, portfolio companies, and it's a nice idea, and it's quite novel but elegant compared to options that expire. There are a number of sort of nuances and disadvantages to having to roll options. But yeah, I'm not aware of anyone having actually built that out yet, or being at a stage where they're seriously intending to build that out. I also still think like that we just haven't seen proof that there's a really strong demand for options yet in the crypto space. So obviously Deribit is the largest venue, and even those volumes, just like relative to the perp volumes, are incomparable compared to trad markets, where in some markets option volumes greatly exceed futures volumes. Part of me thinks it's just a very retail oriented market. Crypto is, and even where we see crypto demand for trading options, which is like Robinhood, right? They've been super successful with this last year or so with options on GME and Tesla and such. Really, those things I just view as a proxy for bored people gambling, and so if you can be a bored person gambling with shitcoins and perps in crypto, you don't really need to try and do options, because it's more options are a bit more esoteric, and any regular retail consumer picking up some sort of options GUI is going to be pretty scared by what all the things mean and how everything works, and so it probably does make a lot more sense for them to be gambling on shitcoins than gambling on options.
Thank you. That makes sense.
Awesome. So that wraps up this debate. Dan, Bryn, Evgeny, thank you so much for sharing your thoughts. Thank you, audience members, for tuning in and all the great questions. We'll be posting a transcript and then a recording of the audio on the dYdX blog later this week. And thanks again, everyone, for joining.
Sam, thanks for having us.